What do you feel when the market gets violent? Fear? Danger? The urge to wait on the sidelines? That is how most people react. But what if that instinct is exactly why ordinary people fall behind in building wealth? Today's idea is simple. Volatility is a discount. This is not blind optimism. This is not motivational fluff. It is a structural way of looking at markets without letting emotions run the show. Right now, the world feels unstable. Geopolitical tension, inflation fears, interest rate uncertainty, economic slowdown. Every headline seems designed to make investors nervous. And when people get nervous, they want to run to cash. They say things like, maybe I should wait. What if it falls even more? This is too risky. And emotionally, that makes sense. But in investing, the biggest opportunities rarely appear when everyone feels safe. They appear when fear pushes good assets below their real long-term value. Think about it. When the economy looks strong, when headlines are cheerful, when everybody feels confident, stock prices are usually already high. Why? Because optimism gets priced in fast. But when fear takes over, people sell first and think later. Prices fall. Sometimes they fall hard. And sometimes the price drops, much faster than the actual value of the business. That gap is where opportunity lives. And for ordinary investors, that may be one of the only real windows to build serious wealth. Most people focus on what to buy. But what matters just as much is when emotionally difficult moments appear. And whether you can keep buying anyway. If you buy great businesses at expensive prices, your future returns shrink. If you buy great businesses when the market is full of panic, your future returns expand. That is why volatility is not just fear. It is also a temporary increase in future expected return. Now let's be clear. This does not mean everything becomes a bargain just because prices are falling. Bad businesses can get cheaper and still stay bad. Over-leveraged companies can collapse. Hyped stocks can fall and never recover. So the point is not to buy anything that crashes. The point is this: when fear hits the market, buy quality with discipline. That is the real game. And this is especially important for beginners. Early in your investing journey, your average purchase price matters more than most people realize. Imagine two investors buying the same great company. One keeps buying mostly when the market is calm and expensive. The other keeps buying during uncertainty when prices are under pressure. 10 years later, they may both own the same business, but they do not own the same outcome. Why? Because compounding does not just reward time. It also rewards the price you paid at the beginning. If one investor buys at $100 and another buys at $70, and the stock eventually reaches $200, the first investor doubles their money. The second investor does far better. The difference may look small at first, but over time that gap hardens and grows. It becomes the silent force shaping future wealth. That is why what you do during ugly markets matters so much. Here is the pattern that traps most people. They start investing when markets are going up. Why? Because it feels safe. Everyone around them is making money. The news sounds optimistic. They feel like they are missing out. So they buy high. Then when the real sale finally arrives, they freeze. They get scared. They stop buying. Some even sell. And that is how people end up doing the exact opposite of what investing is supposed to be. They buy high and sell low. Not because they are stupid, because they are emotional. That is why investing is not about prediction. It is about design. You do not need to call the bottom. You do not need to guess what the market will do next week. You do not need perfect timing. What you need is a framework. When markets turn ugly, you need to be able to say, this may not just be danger. This may also be a discount. That shift in perspective changes behavior. Maybe you invest a fixed amount every month. Maybe when the market drops sharply, you add a little more. Maybe you follow rules instead of following your mood. Maybe you stop treating social media excitement like financial analysis. Once you do that, investing stops feeling like gambling. It starts feeling like capital allocation. Short-term volatility is noise. But for long-term investors, it can also be a moving price tag, a chance to buy ownership in strong businesses at lower prices. And that is an important point. A stock is not just a flashing number on a screen. It is partial ownership in a real business. So when fear drives prices down across the board, that does not only mean charts are red. It may also mean pieces of world-class businesses are being offered at a discount. Of course, prices can fall further. Next month could bring worse news. Nobody knows. That is why the goal is not to make one giant heroic bet. The goal is to spread purchases over time, reduce emotional mistakes, and let consistency do the heavy lifting. That is how ordinary people win. And let me say something important here. This does not mean crashes are good. Recessions hurt people. Instability hurts families. Real economic pain should never be treated lightly. But as investors, we also have to understand what fear does to prices. We have to recognize when panic creates distortion. And if we can stay rational in those moments, we can position ourselves for the future. History has shown this again and again. Major wealth is often built, not when the world feels comfortable, but when confidence disappears. Boom times get the attention, but the seeds of wealth are often planted in silence, stress, and uncertainty. So when markets feel chaotic, ask yourself this: is this just fear? Or is this a sale on the future? Because the market always tests people emotionally. And the winners are not usually the people with the strongest opinions. They are the people with the strongest systems. On the days when headlines look terrible, when charts look broken, when everyone else thinks waiting is the smart move, that is often when the real work of long-term investing begins. So I will leave you with this. Don't wait for the storm to pass. Buy the rain while it's cheap. If you wait until the sky clears, the discount may already be gone. Wealth is not always built in peaceful markets. Very often, it is built by people who can look at chaos and see accumulation instead of escape. So the real question is not whether volatility feels scary. The real question is, when fear takes over the market, will you be one of the people running away? Or will you be one of the few quietly buying while quality is on sale? That difference may shape your financial life more than almost anything else. Ending. On this channel, we do more than follow the news. We break down the deeper logic behind money, markets, and wealth in a way that actually makes sense. If you want more content like this, make sure to subscribe.